Absolutely. I mean, pay attention to countries that are forced to import their natural gas. And with Japan being the #1 in the world in terms of its dependency, South Korea being #2. There are a few other countries down on that list, Pakistan, Thailand, and they are, to me, those are the canaries I'm looking at, because it's not an Arab Spring that we're contemplating right now, even though Egypt is in a mess right now. Egypt is on the brink. But we're not looking at an Arab Spring, because last check, Peru is not in the Middle East. No. So you're looking at a global situation right now, and that's why I think, rather than looking at HYG, even though we've definitely seen credit risk start to perk up as the move is advertising and warning and cautioning, but I'm watching how quickly the emerging market space, because they don't have the latitude, they don't have the Bank of Japan in some of these emerging markets, they don't have the same levers, they don't have the same release valves. So you see Sri Lanka simply up and say, we're defaulting. If we don't default on our debt, there's no food. And we have to have time to negotiate with the IMF, so we're just not going to pay on our debt. So we're just going to flat out default. Again, go back to the time compression chamber and how quickly these things are happening. You have twice as many emerging market countries right now with debt levels that are trading in distress north of 1,000 basis points north of a US Treasury. That's twice as many as you had in the immediate aftermath of the pandemic hitting. So we're in a much more dire situation here. So if you want a front row seat with popcorn, follow the EM space.
I like what you've said about EM, but the interesting thing is a lot of EMs are in the commodity space as well, and they've held up. I've actually watched the Brazilian real firm. I've watched my donkey currency of my homeland, South African rand, actually come from around 16s to 14.5s. Gold, platinum, bit of agri, Brazil, clearly the same, you know, cacao, coffee, a lot of these things starting to get real money pricing and re-rating on the commodity long. We have to be specific to the ones that are super over indebted and are not got too much of a commodity power on energies potentially. And I'm also noticing that what's first world, you've mentioned them, and our big bears are the USD Korean won. We are expecting huge blow off moves. The Korea and Japan are not easily the Turkeys, the South Africa and the Brazils, but I feel that there's more of a westernized Eastern nation currencies, if I can say that, those that have been pro or at least sympathetic to the westernized world, the yen, the Korean won. I feel that they are coming almost more into the headlights than you would have your usual dirt box of the emerging markets. What are the motives? We've got demographics that are working very negatively. I mean, Korea, they have even less babies.
Yes.
They have debt.
I think what's playing out here is that we're seeing how very vulnerable net energy importers are.
Yes.
This is not something you can fix quickly. Germany, to take but one example, is fast tracking building out LNG ports. That's fine. At best, they're going to come online 2025, 2026. That's a dog year in economics. Right now, months are dog years in economics. And so you're seeing how vulnerable energy net importers are. I'm going to go back to Brazil for just a second, though. Bolsonaro comes up for election in October. Guess who's spending his energy dividend right now? He is. He's pumped $35 billion into aid for the poorest people. To me, there's a parallel to be drawn between Xi Jinping and Juan Bolsonaro, because they're both doing the same thing. They're pumping as much money into their domestic economies as possible. So I would dare say that 20% appreciation in the Brazilian real might be a bit aggressive, considering that Brazil itself is already in stagflation as well.
Oh yes, the last thing I'm ever going to try to sell anybody is that they are paragons in virtue and don't have incredible debt problems, but they're kind of getting a small, the way I paraphrase this, I've just brought up a share because I've tried to do the currencies on a strength versus weakness, and you were hitting the nail on the head on a number of them when we were referring to the yen that I put as one of the most exposed. Of course, emerging markets should be in there. They don't have the same scale. But in some senses, the quality of Japan is what allowed them to get even deeper into debt than the normal emerging markets has been available. And you also hit the nail on the head when you were referring to, apart from high relative debt, it's the need for imports of commodities, specifically energies, but not exclusive to energies. And the other element I threw in there is, deep down, people are also asking how much precious metals people are holding relatively. We know what Britain did, they dumped 400 tons. And then we look at what they're doing in terms of yield control, curve control, which Japan is already involved in, and the EU is contemplating. So in some senses, I'm just curious, where would you put the Brazilian real, say, for example, versus, say, the yen and the euro? We're comparing in an FX emerging that has lots of faults, admittedly, but we also have these more privileged, deemed first world nations that have almost been given a bigger overdraft and have used it. Who's the ugliest? We're doing a beauty contest in the leper colony, essentially, and we're asking who's the least ugly and who's the ugliest of them all. I'm just curious as to how do we measure that? How do we measure Brazil versus the Korean won and the yen?
Well, I think when you look at the Japanese yen having seemingly hit a ceiling of 130, that the global FX markets are telling you that if you take one more step down that pathway, that again, something is going to break. And and 20% appreciation in the Brazilian real. I get that it's a net exporter. I understand it's got energy. It plants a lot. I understand all of that. But when you consider what's already been priced in, I think you have to take that and contextualize it, given China is not going to be buying as much. I'm not talking about food, but I'm talking about China's not going to be supporting global commodities exporters, copper, iron ore, the way that they did in 2016. They simply don't have the financing. They simply don't have the funding. And Xi Jinping has to look towards that 20th People's Congress. And so that's why I think you should parse whether or not you're talking about a food exporting nation or a metals exporting nation, because there's a distinction to be drawn if you're talking about a global industrial recession that China's not able to rescue.
Yeah. Yes, and of course, metals and construction, they've actually allowing far more of their property correction to occur than people gave credit for. And so therefore, I would imagine copper, concrete, and industrial irons and ores, Australia won't get the same skipping through the great financial crisis it got when China spent for the world during that era post 09 through to 14, 15 until their Shanghai Accord in 16. That's a very interesting history and opinion. Do you have a view, because Japan was popular and famous, I'm dragging you maybe a bit out of the American economy, tell me if you're just so globally switched on, I'm sure you're comfortable here as well, but there was a carry trade syndrome in Japan in terms of speculation, because they had the lowest interest rates in the world. This was pre all the multiple QEs and we all went down the same path. What is the function of that, and is there a major carry trade unwind, or is that something that dissipated anyway when we had the normalization of our rates down to their level, or is there still some degree of structural danger in the legacy carry trade in terms of using the cheap funding to buy, and now there's yen exposure?
Right. I would argue, and I'll never forget the day when I was working at the Federal Reserve at the time, that I called the director of research and said the carry trade just broke. It was a Sunday afternoon. When the Japanese yen carry trade broke, I would argue that you're seeing in the full-on reversal of negative yielding sovereign debt, that you're seeing a violent unwinding of a carry trade. And that is why you're seeing a walloping of the euro and the yen. Because again, if you're talking about the cheapest borrowing rates globally, you were going for the Bund, you were going for the JGB. That's where you were playing that hand. That's where you were putting that trade on, and you can't in this kind of an environment when the Fed won't shut up.
Yeah, and our tightening. So back to what breaks first. We're all guessing, we're all scenario casting, we're all likely to be wrong, but how do you see this unbelievable quagmire we've been caught in? And I'm assuming, is it fair enough to say that you see the Fed as being badly behind the curve? How does it break?
Look, I have no idea. I don't know. I don't know what systemic looks like. I don't know what systemic looks like in this environment. I know what systemic looked like in 2018, 2019. There was this great concern that even in a rising interest rate environment, that Japanese banks were overly exposed to U.S. collateralized loan obligations. Last check, they're probably still sitting on those balance sheets. So again, I'm hyper focused on bleed through to credit, whether you're talking about the EM space or that of the US high yield debt market or that of Europe's high yield debt market as well. People have not been talking enough about the disruption in that market. The issuance market in Europe has been under siege longer than that, and to a greater degree than that of what we've seen in the United States, and that bears some paying attention to because of the way that the financial market construct has changed since the pandemic. You've got more dollar denominated debt, not just in sovereigns, not just in foreign non-financials, but you've also had this massive evolution in the European bond market as well, as they've tried to step away from being so dependent upon their banking system for their leverage.
And isn't that got this whole debt instrument, hasn't this got unbelievable repercussions? I mean, Raul did a very good on Real Vision about the plight of pensions. And of course, pension funds are inadvertently, I would describe them as the dumb money that have been holding the other end of being net purchasers of bonds on account of the annuitization principle and having some secured, stable investment. This is how it was sold. Obviously, the bonds were the boring markets. If you wanted excitement, you went to equities. And now we're in this almost inverse end of cycle where actually all the action is in the sleepy tortoise zone, and that there's serious potential repercussions for pension schemes. And this almost means that this could lead to a whole new deal. Do pension schemes even have a chance actuarially of surviving the decimation of this asset class?
I mean, here's the irony, right? They've been waiting for these level of high rates for so long to match their assets to their liabilities. Now that they've got them, what liquidity do they have? Because they've got so much tied up in private equity and illiquid assets that are dependent upon the capital markets being open. So it's not as if they can flip a switch and reduce their equity exposure and increase their bond exposure just because the 30-year long bond yield is looking pretty attractive right here. So there's your irony, and the risk in the pension system is so underappreciated. You've got Ken Griffin putting tons of money behind trying to oust the governor of Illinois, the head of Citadel. I mentioned something that's that micro in nature because if you have rational players at the same time that the pension system is blowing up, God help us. Because for generations now, the weakest pension players have simply been able to, and the markets have allowed them to issue more bonds like a Ponzi scheme in order to care for the underfunding situation. But in a true recession, and if capital markets were truly to seize, given how large the shadow bank has become and how exposed to alternatives pensions are, you could have a serious situation where illiquidity became a very big problem.
Yeah, and that means capitulation because the absence of bid. The dark market, the derivative market, surely there must be untold reverberations and conversations going on with the brutal change in the yields and the loss of value in the debt markets. Could this is something so few people understand. It's almost like a black box. Could not there be some major exposures? You mentioned Japan's potential position in terms of that, maybe Korea's, but there's also big corporation players. Could we end up in a bailout situation again on account of quadrillions of closet derivatives that are all becoming deeply unsettled? And there was one other thing that occurred. Sorry, while I'm going to just addend this to this question. We saw that there was, during the period of the repo market seize, there was some incredible article that actually pointed to the better part of around 48 trillion all told. I think the highest recipient was BNP Paribas, with about 3.89 trillion during the repo markets that were lent out to various 25 of the largest banks. And that was very, very dark. It didn't get covered by the mainstream media on any level. Have you come across that article? What were your thoughts about the absolute scale of the plumbing patch-up job that was done during what most people skipped through and didn't even notice? And that was the last That was 33 months from the previous yield curve inversion, 19 September, October 19. What's your take also on that in terms of, it feels like a bit of that derivative bomb, the sensation?
Well, so, you know, it's more difficult to say what the reverberations are going to be through the US banking system, because the Federal Reserve has set up these facilities to ensure that the sins of the past do not recur. And that's why, even though you're right, the Fed kept it under, they probably pushed their legal limit in terms of how long they could keep that information under wraps. But I think it's going to come down to the idea of stigma, and whether or not, if there is disruption in the overnight lending market, if the banks are willing to use some of the new facilities that the Fed has created, such that there's not a repeat of the repo madness that we saw in 2019. So if the banks allow themselves to be identified as weak players, which they didn't have to last time, but if the banks were to go that route, if the Fed had the power to force it, and they've been trying to get banks to participate in this new standing repo facility, and they have not been getting a warm reception, because again, you don't want to show your hand. But I would say this much: big US banks have de-risked in a big way. Same cannot be said of small, medium, mid-sized banks in the United States. And the thing that is spoken of the least, especially given, you know, you've got 82.5% of New York City workers that are back on the payroll since the pandemic hit, and yet you've only got 40% of the office space occupied. There's a massive disconnect there, and somebody holds the loans to these office, all of these mortgages. Somebody's sitting on this paper, and they've been extending and pretending these loans in the post-pandemic era, hoping that life would go back to what it was before. But if you've got 80% of the workforce back being employed, but only 40% of offices that are occupied, one versus the other, there's a massive disconnect there, and somebody's going to be left holding those loans. Banks will be involved.
Pension funds, again, were big investors in commercial property.
My gosh, pension funds plowed into especially private deals. And you know, their managers sold them on the importance of having a hard asset in times of disruption. You know, all they needed to do was sit down with Christopher Cole, and he could show you the last 100 years of history, and the fact that real estate is extraordinarily and painfully pro-cyclical during times of disruption. So that, I think, is more than derivatives. I think commercial real estate, especially because it's such a global entity right now, and so many people have poured money into it. Private equity and has poured money into the global commercial real estate market and into multifamily and residential in the United States. These are the things I think are not spoken about enough, because somebody's got debt against these properties.
Correct. And there's no income on it anymore, and there's no view that it's likely to return. With everybody working from home, everything is a Zoom, everything is remote. It's going to.
You know what? Yes and no. There's only 10% of the workforce that's working from home right now. That used to be around 30%. Again, firms have been spending aggressively on automating.
Yeah.
That's what they've been spending their money on. So the same number of jobs simply are not there.
Yeah. So we're already delaboring for the AI robotic world to a large degree. We're already bridging to that.
That was dramatically amplified and accelerated in a post-pandemic world, because there's this lovely notion that you know, worker empowerment. It sounds great. I mean, this is election season. Let's sing it to the hills. Why are corporations just going to roll over? I understand that labor costs are increasing, and rightly so, because the pendulum, it swung too far. That said, where have they been invested most aggressively? In trying to replace human beings with machines.
Correct. There's something going on in farmland. Here's our sketch a story. So UK farmers are being encouraged, and they of a certain generation in many ways, to almost be paid to retire and resign. There's been a lot of big oligarchies accumulating farmland in the US. There's a lot of doomsday speakers. There's just a recent name that I was referring to, who was talking about there's likely going to be a supply chain shortage of agricultural foods. We're kind of inverting Maslow's hierarchy of needs. We're no longer talking Bugatti Veyrons and private jet flights. We're talking about food provision. And I'm trying to check the names. James Aitken has been appearing, and he's been talking a little bit about, as a macro strategist, how the back end of this year could be deep supply shortages of basics. So we're talking about food supply. And there's something also going on in farmland. It's kind of, they seem like two disparate, but is farmland going to be the new commercial real estate because of that yield, that requirement, the scaling of farming? Already farming's become so efficient. They've big scale business. It's so automated. You can have a family of 4 running 60,000 hectares with the equipment and all that, quite advanced. And it was reduced to being very efficient and highly marginal. Most of the profit was being soaked up by the supermarket chain, who was buying real hard, had real scale, and then was packaging and marketing. Are we going to see a return of joy? Because in the 30s, many people don't know this, but historically, farmland had a bit of a bubble post in the lead up to the 30s. What's your take on the agri-producing ground and land?
Well, so this is not an area of expertise. However, I can tell you that one of the greater risks is that there is leverage in this space. And yet, since the 1930s up until today, the one variable that has not changed is Mother Nature.
Yeah.
So the risk is there, and because there's such a need, because you're pulling this third of the world's wheat effectively potentially off the market, and I don't anticipate that that's going to be the case. I think you get wheat out of Ukraine. I think you get some, but I think that there's still going to be a gaping hole that's left behind in terms of what we don't get from them. But as long as Mother Nature behaves, I think that we're going to be fine. If she doesn't, God help us. Because there is leverage. There is leverage in farmland. Farmland has been one of the hottest, quietest, hottest asset classes, the place to be.
Yes, and you don't see that stopping anytime soon, or you think it's already overbought?
Well, look, people right now are desperately seeking out safe asset classes. I'm sorry, I forgot to do my air quotes, safe asset classes. So and there's trillions and trillions and trillions of dollars of dry powder in the hands of private equity firms that continue to raise these mega funds. They continue to be in the marketplace raising fresh money. So when you have a situation where money has to be deployed or you're not going to get paid a fee on it, then you're going to get some of the stupidest deals in all of mankind's history. Yeah,
and that's the problem. Too much liquidity chasing the logical trade. It's been fascinating, Danielle, with all the risks potentially to the downside on equities. What would be your 3 bullet, without on a non-advisory basis, but your 3 bullet defense strategy for these times? If I were to just look over your shoulder to the next Quill Intelligence feather letter, by the way, everyone should be registered and consider your service at Quill Intelligence, Danielle DiMartino booth. What would be the top 3 bullets of defense for surviving and thriving in these crazy times?
So the monies have already been allocated to many states and municipalities, and because of the high interest rate environment, you've seen municipal bonds in the United States really take it on the chin. If you're a holder, then you're fine. You're sitting on potential unrealized losses. That being said, there are going to be the opposites of Illinois out there. There are going to be very safe places to park your money. I would also point you to companies with strong balance sheets that are in the staples universe that have a dividend, that's not going to be at risk. Because the one thing that we saw with the post-pandemic era was this wave of companies canceling or suspending their dividends. So if you can get protection on that front, then certainly do so. And I stick with precious metals, so I think that's something of a cop-out trade. But I will say this much: I think that the home building sector, consumer discretionary sector, given, again, it's a midterm year, I wouldn't fall into the value trap of saying they're down so much, I need to jump back in. There's going to be plenty of up days where you think you kind of psych yourself out, but be very careful in this space. And that's what we've been advising to our clients is industrials, consumer discretionary. And by the way, energy's gone really far. And one must wonder also if energy is also a value trap. And there's so much money that's been made in this space. I would caution against one other thing, and that's that if you're looking inside the US high yield market, the most exposed sector, last generation it was energy, this generation it's healthcare.
Yeah.
And that's a little bit less obvious of a sector to be at risk, but that is indeed where some of the riskiest paper is, which some people would think of healthcare demographics being a sure thing. Be very careful and do your research.
That was an amazingly good and succinct. You triggered me on one more if you've got the time. Equities, some people feel that equities are a safe place generally in a place of inflation. Of course, you've already been very specific about which areas of equities. It's very broad brush. But one of the concerns that did get created with this buyback realm that I was failing to mention, and I just thought I'd bring in, many companies borrowed to purchase back stock. Surely that must be an absolute poison pill that is going to detonate, and making sure you're not holding, and if you are of a trading, you're possibly judicious, well-managed short positions on the big buyback parade that are not income generative. So you stay out of the ones like Apple that are real cash machines. But there are a lot of second-rate companies, so General Electric, IBM, fallen angels, that have had quite a big history of buybacks and must be significantly more leverage. Simon Black did something on Coca-Cola where he compared it a decade ago to more recently, and everything was down. The debt levels were up, the earnings were down, the growth rates were down, but the share price was a 3x. And is this not a sweet spot for real re-ratings to the downside in the equities? Or is the inflation trade just don't go against probably what's a double digits inflation rates if you're trying to be too smart?
Well, you can be too smart, or you can be overly long equities going into an earnings recession. So
yeah.
Inflation cuts both ways, and as long as companies are not able to pass along price increases, and if price pressures do become pronounced, as we're starting to hear from some companies, and they have very murky outlooks going forward to the rest of the year. Remember, the second and third and fourth quarters in US GDP growth were supposed to make up for the weak first quarter. And now what we're seeing is the first quarter is coming in somewhere around 1%, and the second quarter's drifting down towards 1.5%.